January 12th, 2026, the U.S. Department of Justice announces the opening of a criminal investigation into Federal Reserve Chairman Jerome Powell at the direct request of President Donald Trump. Within just the first 4 hours after the announcement, the dollar weakened noticeably, with the USD Index dropping 0.8%. Gold prices surged 2.1%. The yield on 10-year Treasury bonds rose from 3.92% to 4.07%. These movements are not rumors, they are verifiable numbers in trading data. The market is telling you that it sees a risk. Most of the public has yet to recognize political risk to the Fed, the foundation of USD stability, and this is not the first time history has shown us this kind of reaction. When politics gets too close to the central bank, the world's largest financial institutions are always the first to act. They don't wait for explanations, they read the signals, and their money moves first. What is happening today has happened before, 3 times in modern history, each time leading to the same kind of outcome: shaken confidence in the reserve currency, smart money fleeing the leading nation, and markets entering a volatile phase for which the vast majority of the public is unprepared. Went through this in 1972, when the White House pressured the Fed ahead of an election and unleashed a decade of runaway inflation. Turkey went through this in 2018, when the government directly intervened to slash interest rates and the lira collapsed. Argentina has gone through this for the past 40 years. These patterns share one thing in common. They follow a predictable cycle. The same stages, the same warning signs, the same outcome. And we are watching that cycle unfold once again, right now in real time. The only question is whether you will recognize it coming or whether you will later ask yourself, like millions before you, why all the signs were right in front of you and you missed them. Come with me, because the next 15 minutes will change the way you look at the dollar, the power of the Fed, and what is really happening inside the US economy in 2026. There is a pattern that has repeated for centuries, and each time it appears, the outcome is so similar, it is almost mathematical. When political power gets too close to the central bank, a 4-stage cycle is triggered, unfolding quietly but relentlessly, and always ending in the weakening of the national currency. That cycle is not a hypothesis, not a cautionary tale. It is a law proven by numerous instances of monetary intervention in history. And what is happening in the US in 2026 shows we are entering that very cycle. The first stage is the smoldering pressure phase, where the conflict between politics and the central bank has not yet fully surfaced, but has been forming from very early on. This phase began in 2018, when Donald Trump repeatedly criticized Jerome Powell. From the very first months, Powell took the Fed chair position. Trump publicly demanded the Fed cut interest rates to 0% to boost the stock market and economic growth. Powell refused, prioritizing price stability, and that refusal caused the tension between the White House and the Fed to subside on the surface while smoldering underneath. The criticisms, sharp tweets, and tense behind-the-scenes meetings laid the foundation for a prolonged confrontation cycle. Stage 2 is when the conflict escalates. In 2025, Trump returns to the White House with commitments to rapid growth, aggressive tax cuts, and market support. To achieve that, he needs low interest rates. But Powell, facing persistent inflation and a still hot labor market, maintains the stance of higher for longer rates. This is the tipping point where the White House no longer sees the Fed as an independent agency, but begins viewing it as the biggest obstacle to the president's economic agenda. It is during this period that political pressure shifts from verbal criticism to systemic pressure. Closed-door meetings grow increasingly tense, rumors of changing Fed leadership emerge, and the confrontation ceases to be personal and becomes a clash between 2 centers of power: the White House and the central bank. Stage 3 is the direct assault on the institution. Every cycle of political intervention in a central bank has a breaking point, an action that marks politics officially crossing the line of authority. For the U.S., the moment is January 12, 2026, when the Department of Justice announces a criminal investigation targeting Powell based on allegations related to a Fed headquarters renovation project worth over $2 billion. The Fed immediately pushes back, stating this is an attempt to undermine their independence, and the market understands this better than anyone. This is not just an internal dispute. This is a signal that the White House has chosen direct confrontation with the Fed, and stage 3 of the cycle has officially begun. Stage 4 is the market consequence, where all financial dynamics react instantly before the public even realizes what is happening. Bond markets start pricing in political risk. Yields rise not because the economy is worsening, but because investors demand compensation for the possibility of Fed interference. The USD weakens as confidence in the world's most important monetary institution falters. Major funds begin adjusting allocations, shifting to gold, the Swiss franc, Singapore bonds. Because when the central bank is dominated by politics, the national currency is no longer seen as an absolute safe asset. And the conclusion of this section is the core law of the entire cycle. Once politics seizes control of the Fed, markets react before the people see it, and the outcome is always the same. Eroding confidence leads to a weakening currency. History always leaves clear traces, and when we look closely at moments when political power tries to bend the central bank, we see a familiar pattern repeating with near absolute precision. To understand what is happening with the US in 2026, we must look back at three major past examples. Three moments when politics touched money and markets reacted immediately, creating irreversible disruptions. The first case occurred in Washington, D.C. in the early 1970s. From 1971 to 1974, President Richard Nixon applied intense pressure on the Federal Reserve to keep interest rates low ahead of the 1972 election. It was a period when the White House wanted fast economic growth, a strong stock market, and lower unemployment, favorable signals for re-election. But the Fed, forced into excessive easing, lost control of inflation. Data shows inflation jumped from just 3.3% in 1972 to 11% in 1974. At the same time, eroding confidence in the dollar caused the Bretton Woods system, the system tying the USD to gold, to collapse completely in 1971. When the US ended dollar-to-gold convertibility, the dollar officially became a fiat currency based entirely on international trust. And it was at the moment trust was shaken by political intervention that the global reserve currency entered a decade of severe volatility. The lesson of that period is very clear. Once politics takes the wheel of the Fed, inflation spirals out of control and the USD weakens in the eyes of the world. The second case happened not long ago in Ankara, Turkey. From 2018 to 2021, President Recep Tayyip Erdogan repeatedly pressured the central bank to cut interest rates despite relentlessly rising inflation. Erdogan believed low rates would stimulate growth, but imposing monetary decisions against economic laws plunged Turkish finance into chaos. In just 3 years, the lira lost 80% of its value, causing living standards to plummet and import costs to soar. Inflation in 2022 exceeded 80%, marking one of the most severe currency crises in the nation's history. The lira's collapse did not start from external factors, but from the moment the central bank lost independence and had to obey political demands. When trust in the currency issuing institution vanished, the lira was no longer a store of value. This is a classic proof of the pattern. Central bank-controlled markets move first, currency collapses. The third case occurred in Buenos Aires, Argentina, a long-running example spanning decades. Over 40 years, Argentina has replaced more than 20 central bank presidents. This constant change was not due to reform or progress, but mainly because successive presidents wanted to control monetary policy for short-term political goals. The result, the peso depreciated more than 7,000% from 1983 to 2023. And in 2023 alone, Argentina's inflation approached 200%, pushing the economy into a state where every citizen understood that wages, savings, and financial futures could evaporate in just months. When the central bank stops being the protector of currency value and becomes a tool serving power, the nation loses not only international market confidence, but also the confidence of its own people. That is a form of collapse that starts from within. Looking back at these three cases, what is clearest is not the differences between the US, Turkey, or Argentina, but the similarity in the operating pattern. Politics intervenes in the central bank. Markets spot the risk before the public, smart capital flees, and the national currency weakens. And every time this pattern repeats, markets always move ahead of any official statements. This is the context for understanding why the 2026 investigation targeting the Fed chair is not just a political event, it is a critical signal in a cycle history has proven many times. From 2023 to 2026, a quiet but powerful shift has spread across the global financial system. This is the period when U.S. interest rates remained at multi-decade highs while political tensions between the White House and the Fed escalated month by month. The criminal investigation into Jerome Powell was only the final spark that drew market attention, but the wave of silent capital flight from the USD had begun long before, led by nations and institutions that saw the risk from America's political instability. China is the clearest example. In 2013, they held nearly $1.3 trillion in U.S. Treasury bonds. By 2024, that figure had fallen to about $770 billion, and in 2025 it dropped further to $760 billion, the lowest since 2009. This change was not impulsive but a deliberate strategy to reduce USD dependence, reflecting prolonged geopolitical tensions and the growing trend of increasing gold, euro, and alternative currency reserves. No official statements, no public debates, just billions steadily leaving US bonds, exactly that they quietly leave. Pattern history has seen in past currency cycles. Japan, the world's largest holder of US Treasuries, showed a similar trend from 2022 to 2024. Japanese institutions net sold about $220 billion in Treasury bonds. This was largely to support the yen and rebalance portfolios as Japan's monetary policy began shifting after years of negative rates. They did not declare abandoning the USD, but the monthly published numbers were enough for markets to understand the message: they are reducing risk in silence. Saudi Arabia is also changing. In 2024, the country's treasury holdings fell to the lowest level in 6 years. At the same time, Riyadh stepped up domestic currency fundraising and expanded oil transactions in multiple currencies, according to Reuters surveys. Though Saudi has not declared distancing from the dollar, diversifying currencies in oil trade, the foundation of the petrodollar system is a signal they are calculating a more flexible position for the future. In Europe, countries like Belgium, Switzerland, and France reduced U.S. Treasury holdings by 5 to 10% in 2024. The scale is not as large as China's or Japan's, but it occurs amid the EU building independent payment systems from the US to limit risk when the USD faces political pressure. Parallel to international capital outflows, the Fed itself is shrinking its balance sheet. From $8.9 trillion in 2022, it fell to about $7.4 trillion in 2025. When the Fed stops buying bonds, the entire burden of financing deficits shifts to the market. International investors see the danger. If the Fed is constrained by politics after the Powell investigation, they will no longer trust it can act independently in a crisis. And that is why risk on USD-denominated assets is rising. All these shifts share one thing in common. They happen quietly, without fanfare. Only money flows out billion by billion, reflecting a truth nations understand very well. When confidence in America's political environment declines, capital does not wait for media confirmation. Within the first 48 hours after the Department of Justice announced the criminal investigation into Fed Chairman Jerome Powell, from January 12 to 14, 2026, global financial markets reacted faster than any political statement or press conference. This was an instinctive reaction of money flows, a jolt from a capital system extremely sensitive to signs of instability in America's power structure. The clearest sign appeared right away in the USD. The USD Index fell 0.8% on the first day and a total of 1.2% over 3 days. This was the sharpest drop following a Fed-related political news since 2011, when the debt ceiling fight shook markets. A global reserve currency does not fall on emotion. It falls only when confidence is affected, and the market has confirmed that confidence is being shaken. Gold, the ultimate safe haven asset, immediately broke out. Spot gold prices surpassed $2,100 per ounce, marking a new high. Gold ETFs recorded the largest inflows since Q3 2020, when the pandemic triggered a global flight to safety. This shows the run-to-safety reaction is happening at high speed, and that is always a sign the market recognizes systemic risk. U.S. Treasury bonds, considered the foundation of the global financial system, were not spared. The 10-year yield jumped from 3.92% to 4.07% in a single day, a huge move for an asset that usually moves slowly. The 2-year yield rose even faster, reflecting expectations that the Fed would soon face pressure to change its policy path, causing the market to reprice the entire yield curve. When the yield curve reacts toward instability, it shows investors believe the Fed's power structure is being directly impacted by politics. Major financial institutions also issued warnings in unison. Goldman Sachs emphasized that risk to Fed independence has fully appeared on the market's radar. BlackRock described it as a political risk premium being imposed on U.S. assets. Bridgewater went straight to the point: markets hate uncertainty, and political intervention creates uncertainty. These statements are not mild commentary. They are indicators that major institutions have raised their internal alert level on the U.S. financial environment. Global capital flows also began seeking new directions. Some funds actively increased allocations to Singapore bonds, Norwegian funds, and commodities, including gold and industrial metals. This is a familiar motif in every cycle of lost confidence in the USD. Investors do not flee en masse, but diversify step by step, shifting portions of portfolios to assets not dependent on U.S. political conditions. This appeared in the 1970s, in 2011, and now it is back. Markets do not wait for congressional hearings. They do not wait for White House explanations. They do not wait for Fed reassurances. They react immediately to data, to risk, to signals. An attack on the Fed chair, however interpreted, is understood by markets as an attack on Fed independence, and that independence is the single most important pillar of the USD. And when that pillar wavers, every market movement becomes purposeful. Now let me show you why America right now is entering stage 3 of the cycle of politics seizing control of the central bank. In this model, stage 3 is not a warning, it is the breaking point, the moment when political power officially collides with the Fed's independent structure and global money flows begin reacting instinctively. Stage 3 always has two features, a direct assault on the institution and a silent exodus of capital. When both appear together, it is always a signal that an economy has entered deep instability, and the US, from late 2025 into early 2026, has exhibited every sign of this stage. First is the assault on the Fed's core machinery. The criminal investigation targeting Jerome Powell is not merely an administrative matter or personal conflict. It is a direct action against the single leader with authority to steer rates higher or lower, to ease or tighten, the person holding the most important key to the dollar. Once the Fed chair is dragged into the political vortex, the entire credibility of the central bank is immediately placed in a vulnerable position. That is the hallmark of stage 3. Independence threatened at the very center of the system. But stage 3 does not appear through a single event. It always comes with capital movement. And in the case of the US, this shift had been happening for years before the Powell investigation was announced. Bond holdings, when major funds adjusted portfolios to lower USD dependence, when yields reacted more strongly than usual to political news, the system entered the other half of stage 3, silent exodus. This is not unfamiliar to history. In 1555, when the Spanish court deeply intervened in national finances, major merchants withdrew capital to Genoa and Amsterdam, beginning the decline of the empire that once dominated Europe. In 1690 in the Netherlands, when the Bank of Amsterdam was overtaken by politics, international financiers immediately shifted to London, creating the rise of a new center and starting the end of the Dutch Golden Age. From 1949 to 1967 in Britain, when the pound was controlled and the government heavily intervened in monetary policy, international investors quietly moved to US assets, and the pound slid for many years afterward. The common point in all three cases, markets saw the risk before the people did, and they left before the consequences became obvious. The story is repeating, only this time it is happening in America. Looking at the 2025-2026 period, we see troubling similarities. The Powell investigation is the symbol of institutional instability. International investors are losing faith in Fed independence, shown by their reduced purchases of new bonds and demands for higher yields. The Fed is conducting QT, shrinking its balance sheet, making capital markets more sensitive than ever. At the same time, the government needs low rates to sustain growth, while the Fed firmly keeps rates high to fight inflation. This is not just disagreement. This is a power conflict. And when two centers of power clash, markets understand the risk lies in the policy structure, not in economic numbers. The conclusion of this section is very clear. America has entered stage 3. No longer the early signal of stage 2, no longer a distant warning. This is the stage where the cycle has passed the point of no return, and what follows will follow the trajectory history has proven no fewer than 3 times. The future of the dollar is not a straight vertical drop in a single night, nor is it the chaotic collapse of currencies and small economies. The US remains the world's largest economy, accounting for nearly a quarter of global GDP. The USD still plays a central role in international payments, comprising about 58% of central bank reserves according to 2025 IMF data. No currency, whether the euro, renminbi, or yen, has the liquidity, market depth, and institutional stability to replace it immediately. That is why the USD will not disappear or collapse in a few months. But what matters is this: long-term risk is rising more clearly than ever. When the Fed shows signs of politicization, confidence, the core element that gives any reserve currency its strength, will be eroded. The confrontation between the DOJ and Powell is not just an internal conflict, it is a signal to the entire international financial system that Fed independence is no longer as assured as before. And when confidence falls, long-term bond yields rise because investors demand a higher risk premium for holding USD-denominated assets. That is something the US has never had to face in the modern era. Alongside that, 4 dangerous trends are happening simultaneously, and it is their resonance that creates real risk for the USD. First is the accelerating pace of de-dollarization. BRICS countries, including China, India, Brazil, Russia, South Africa, and new members, are pushing trade in local currencies or the bloc's common currency. They do not need to declare replacing the USD, they only need to gradually reduce its use. Second is a higher risk premium on US bonds. This was once unthinkable when the USD was seen as the absolute safe asset. But in 2025, 2026, markets have started demanding higher yields, reflecting rising uncertainty about America's political and policy stability. Third, global central banks are increasing gold holdings at the highest net purchases since the 1960s. No one buys gold because of interest rates, they buy it to reduce dependence on a currency with emerging risk. And fourth, nations are diversifying reserves into the yen, euro, Singapore dollar, and Swiss franc. A few go first, the rest will follow when the trend becomes clearer. This is slow but certain erosion. And if you think this only happens to weak economies, remember history's lessons. No one believed the British pound would lose its global status in 1967 until it did. No one believed the Netherlands would lose its position in the 17th century until the financial center moved to London. No one believed Spain's real would collapse until gold flowed abroad. Major shifts in the monetary system never happen when the world is on guard. They happen when everyone believes it can't happen. The USD is no different. It will not collapse overnight. It will erode gradually, small step by small step, percentage point by percentage point of capital leaving, nation by nation reducing reserves. And then at some point, everything happens suddenly, like a bridge that seemed solid but had been hollowed out inside for a very long time. In the context of America entering its most uncertain period since the 2008 crisis, what matters most for every individual is not panic, but preparation. This cycle has repeated for 500 years, and those who understand the pattern are always the ones who stand firm when the system shakes. The first step is asset diversification. No one can rely solely on one currency or one asset class during a period when political risk impacts the Fed. Gold, silver, foreign bonds, real estate, and tangible assets always hold value when currencies lose trust. This is not speculative advice. It is a proven defensive measure through numerous historical cycles of currency weakening. The second step is diversifying country risk. A portion of assets should be allocated to stable markets like Singapore, Switzerland, Norway, or Canada. These countries have transparent monetary policies and do not carry the high political risk level the US has in this phase. International money flows are doing it, and individuals can follow. The third step, and more important than you think, is monitoring Fed independence. In times of instability, developments involving the Fed affect USD strength more than CPI data or employment reports. If the Fed is constrained by politics, markets will react instantly by repricing assets. This is a vital indicator. The fourth step is reducing leverage. Interest rates will swing wildly when the Fed loses independence, and any individual or business using debt will be the most vulnerable. History shows the biggest losers in stages 3-4 are those carrying too much debt during periods of unstable rates. The fifth step is maintaining liquidity. In crises, opportunities often appear as sharply discounted assets, but only those with cash or easily convertible assets can seize the moment. The sixth step is understanding the pattern. This pattern is not new, not unique, and not surprising. It is repeated for 500 years every time politics gets too close to the central bank. Once you understand the pattern, you will see clearly what is happening and what is coming. And finally, the most important message, those who survived the great monetary transitions in history were not the richest. They were the ones with the best information and who acted the earliest. Subscribe now so you don't miss the most important analyses about the future of the dollar and the shifts reshaping the global financial system. Starting today, put yourself in the group that gets the information earliest and acts before it is too late.